Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by EQB Inc, a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing a report from TD Bank that highlights the challenges Canadians face as they renew their mortgages. It seems like a mixed bag, doesn't it, Steve?
Absolutely, Janine. According to the report by economist Maria Solovieva, many Canadians who locked in their mortgage rates during the pandemic are now facing much higher rates as they renew. This is putting a strain on household budgets, though it appears most will still manage to make ends meet.
It's tough to see families having to adjust to these higher payments. I can only imagine the stress it causes when you're trying to balance everything else in life. But there's a silver lining, isn't there, Steve?
Yes, for those who took out short-term mortgages last year when rates were high, they're now renewing at lower rates, which means their payments will actually decrease. In aggregate, Solovieva points out that mortgage payments across Canada are trending lower, and as long as rates continue to decline, especially at the long end, payments should remain manageable.
That's reassuring to hear. But what about those who aren't in the mortgage market right now? How are they faring?
The report does mention that non-mortgage borrowers are facing higher delinquency rates. This suggests that while mortgage holders might be managing, other types of debt are becoming more burdensome for many Canadians.
It's a reminder of how important it is to keep an eye on all aspects of personal finance, not just the mortgage. It sounds like a challenging time for a lot of people, but hopefully, with the right guidance and careful planning, families can navigate through these changes.
Let's take a closer look at the evolving landscape of mortgage lending in Canada, specifically the growing influence of non-bank lenders. A recent report from the Bank of Canada highlights how mortgage investment corporations, private lenders, and investment funds are becoming more prominent players in the mortgage market, traditionally dominated by banks.
It's fascinating to see this shift, Steve. Non-bank financial intermediaries, or NBFIs, are expanding their role significantly. They include entities like pension funds, investment funds, and finance companies, and they're engaging in functions similar to banks such as maturity and liquidity transformation. This positions them as key contributors to the housing finance system.
Exactly, Janine. The value of assets held by these non-bank financial intermediaries climbed by 5.7% in 2023, which is a notable rebound from a decline the year before. This growth, although slightly below the global average, underscores the expanding market share of NBFIs in Canada. They now account for 60.5% of the total financial system assets in the country.
It's important to note, though, that while non-bank lenders are growing, traditional banks and credit unions still hold a substantial portion of the market at 34.6%. However, with the Bank of Canada's share decreasing due to quantitative tightening, it's clear that the landscape is shifting.
The overall size of Canada's financial system increased from $20.1 trillion to $21.2 trillion in 2023, with non-bank financial intermediaries contributing significantly to this expansion. This growth is supported by broad-based asset valuation gains.
And when we look at specifics, investment funds make up a large portion of these assets. Fixed income funds, credit hedge funds, and exchange-traded funds have all posted strong growth. In particular, credit hedge funds grew by nearly 19%, and exchange-traded funds expanded by almost 20%.
Finance companies, which include private mortgage lenders and leasing firms, are also growing, holding 12.8% of narrow NBFI assets. Their growth, in part, reflects the rising demand for residential mortgage debt among non-bank lenders, which jumped by 19% from $338 billion in 2020 to $401 billion in 2024.
It's clear that more borrowers are turning to brokers to find better deals and navigate the complex lending rules, especially as non-bank lending continues to surge. This trend offers more options for Canadians, but it also means they need to be more informed about the choices they have.
Let's dive into recent data on Canadian mortgage delinquencies, which have been on the rise, particularly in Toronto. According to Equifax, while the national delinquency rate remains historically low, it's been climbing rapidly, with Toronto leading this trend. It's one of the highest levels of delinquency seen in decades in the city, even as other major markets like Montreal and Vancouver remain below the national average.
It's concerning to see Toronto, a significant market, experiencing such a spike in delinquencies. While these numbers might seem alarming, it's important to remember that delinquencies are often tied to market liquidity. In a hot market, homeowners who fall behind can often sell their homes and sometimes even profit. It's when home sales slow down that delinquencies tend to rise due to overvaluation.
Exactly, Janine. The Canadian delinquency rate is measured as mortgages that are 90 days or more past due, unlike in the United States, where it's typically 60 days. That extra month can make a big difference, as many loans recover or homes are sold before hitting the 90-day mark. This difference in methodology can skew comparisons between the two countries.
That's a crucial point, Steve. The fragmented nature of Canada's lending system also plays a role. Higher risk borrowers often turn to private lenders, which don't always report to credit bureaus like Equifax. This can lead to underreporting of delinquencies, making it seem like the situation is better than it might actually be.
Right. And despite the increase, the Canadian mortgage delinquency rate is still at 0.22%, which is a 4-year high, but remains below what we saw in 2019. The rate has climbed aggressively, but it's not yet at crisis levels. Most of the stress appears concentrated in Toronto, where the delinquency rate has reached the highest level in over a decade.
It's interesting to note that while Toronto's rates have surged, cities like Montreal and Vancouver are seeing increases that remain below the national average. It's a reminder that the real estate and mortgage landscapes can vary significantly from region to region.
Absolutely, Janine. It's essential to monitor these trends closely, especially as they can indicate broader economic shifts. While it's not yet a cause for alarm, the aggressive climb in delinquencies in Toronto suggests we need to keep an eye on how the market evolves in the coming months.
Steve, let's talk about the recent leadership change at EQB Inc. Chadwick Westlake has been appointed as the new CEO, effective August 25th, 2025. This follows a multi-year succession process and marks an important transition for the company, especially after the passing of former CEO Andrew Moore.
That's right, Janine. Chadwick Westlake is stepping into some big shoes, but he seems well prepared for the role. He was previously the Chief Financial Officer at EQB Inc. from 2020 to March 2025, a period that included some significant developments like the acquisition of Concentra Bank and expansion into capital markets. His leadership qualities and experience were strongly endorsed by Vincenza Serra, chair of the board.
It's always challenging to follow in the footsteps of someone like Andrew Moore, who led EQB for over 15 years. But it sounds like Westlake is ready to build on the foundation Moore left. He expressed that it's the greatest honor of his career to take up the mantle of Andrew's leadership and to further the institution's growth.
Westlake's background is quite extensive. Before rejoining EQB, he had a stint as Executive Vice President and Chief Financial Officer at OpenText Corporation. Before that, he spent nearly 2 decades at Scotiabank in various senior leadership roles. His experience in Canadian banking, wealth management, and global banking and markets will likely serve him well in this new position.
It seems like the board of directors at EQB was very deliberate in their search for a new CEO, with Andrew Moore playing a direct role in identifying Westlake as his successor. It's comforting to know that this transition was carefully planned and supported by a global executive search firm to ensure the best fit for the company's future.
Indeed, Janine, EQB Inc. is positioning itself as a digital-first alternative to traditional financial institutions. And with over $134 billion in combined assets under management, this is no small task. Westlake's vision for the bank's evolution, especially in this defining era of banking, will be crucial in maintaining and enhancing EQB's market position.
It's impressive how EQB serves over 742,000 clients and works with 6 million credit union members through partnerships. This speaks to their significant role in the financial landscape, and it'll be interesting to see how Westlake continues to innovate and drive forward this challenger bank culture.
As EQB navigates these changes, it'll be important to watch how they leverage their digital-first strategy and how Westlake's leadership influences their growth trajectory. It's an exciting time for the company, and hopefully, we'll see continued success under his guidance. We're diving into the latest from the Canadian mortgage scene, where the Royal Bank of Canada has taken a stand against further interest rate cuts by the Bank of Canada. It's a bit of a shift in the landscape, isn't it, Janine?
It certainly is, Steve. While some banks are still holding out hope for more rate cuts, RBC is now predicting that the Bank of Canada will keep the overnight rate steady at 2.75% through 2026. It's interesting to see such a divergence in forecasts among the big six banks.
Exactly, Janine. RBC's stance is quite hawkish compared to others. For instance, Scotiabank has adjusted its forecast lower, now expecting the rate to settle at 2.25%, and BMO is even more optimistic about cuts, projecting a drop to 2.00% by early 2026.
That's right. And while RBC is focusing on the easing trade uncertainties and an uncertain inflation outlook to justify their stance, it's worth noting that TD, CIBC, and National Bank still expect the rate to be cut to 2.25%. It seems there's a lot of uncertainty in the air.
And with such differing views, it highlights how carefully Canadians need to consider their options when planning their financial futures. The right move could vary widely depending on what actually happens with these rates.
Absolutely. And for those in the mortgage market, it's crucial to stay informed and prepared to adapt as the situation develops. No matter the rate, having a solid plan will help weather any financial storm.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.